This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
I'm Gord Long with GordonTLong.com, and I have with me this morning for his second visit to Macro Analytics, Richard Duncan, author of books such as The New Depression, The Corruption of Capitalism, The Dollar Crisis, and publisher of Macro Watch. Welcome back, Richard.
Good, thank you. Thank you for having me back.
Though we've been doing a lot of talking on other subjects that are, for those that are on my website, are very familiar with that and some of the other work. Richard, before we begin, there's a lot of talk in the financial media about what's going on in Thailand and Bangkok specifically with the government. I wonder if you can make a few comments, because I know you were there originally in '97 as an IMF consultant during the Asian crisis, which started right in Thailand because of the baht.
Well, that's right, and I'm living here again. Bangkok is my home now. I'm here today. And yes, there is quite a lot of political disturbance going on at the moment. But it looks much worse on the television than it actually is. Bangkok's a very big city, and unless you go looking for any protesters, you're not likely to find any. And of course, Thailand's a very large country with wonderful beaches and mountains, and you won't find any protesters there. So things are a lot calmer here than it appears by looking at CNN.
I guess it's just a little bit of sensationalism, and I guess because of the '97 and the Asian crisis stemming from it, possibly. Richard, the purpose of our show here today is to focus on your new product, Macro Watch. This is your second quarter that you released it. Could you give our listeners just some overview of the product?
Yes, so the way I see the world now is the economy doesn't work the way that it did in the past. In the past, economic growth was driven by businessmen who would invest, and some of them would make a profit, and they would save that profit, or in other words, accumulate capital. That's why they called it capitalism. And that's how capitalism created economic growth, through saving and investment. But our system doesn't work like that anymore. Our system is now driven by credit creation and consumption, and more credit creation and more consumption. And that's created very, very rapid economic growth in the United States and globally for the last 4 decades. So I think this system has evolved from capitalism into what I call creditism, because it's now driven by credit expansion. The trouble is, it looks like creditism may be on the verge of breaking down into a new depression, because the private sector seems incapable of bearing any more debt. And it's only been the increase in government debt, and that has been financed through fiat money creation, has kept us from collapsing into a new depression, during the last 5 years. So this transition from capitalism to creditism is what I focus on as an underlying theme in my video newsletter, Macro Watch.
Richard, you brought some slides with you that highlight some of the thinking in this quarter's release. Could you take us through them?
Yes, I think the first one is very important. In the first chart showing total credit growth, this is total credit growth for the United States. Now, debt and credit are two sides of the same coin. So one person's debt is another person's credit. So what I mean by total credit in this chart is all the debt in the U.S. Government debt, household sector debt, corporate debt, financial sector debt, all the debt. Okay, it first went through $1 trillion in 1964. And over the next 43 years, it expanded 50 times by 2007. From 1 trillion to 50 trillion in just 43 years. A 50-fold expansion of credit. Well, that explosion of credit, it really created our world in the sense that it has made us all much more prosperous than we would have been otherwise. It created much more rapid economic growth than capitalism would have done if we had remained on a gold-backed monetary system. And furthermore, you could say it has ushered in the age of globalization by allowing the United States to buy trillions of dollars worth of goods from the rest of the world and pay for those goods with dollars denominated in fiat money and treasury bonds. But as you can see, that in 2007, 2008, this credit line begins to dip. And at that point, CreditISM almost spiraled into a debt deflation depression. But thanks to massive and unprecedented government intervention in terms of trillions of dollars of budget deficits and trillions of dollars of fiat money creation, the government managed to make this line grow again. But now we have $58 trillion of total credit. And on such a large base, it's going to be very difficult to make credit continue to grow.
Without question, Richard, it's almost hard to imagine. I kind of look at it very simplistically, that this amount of credit has really brought forward future years' production and capacity. Right now, we globally have a capacity glut that the demand, the aggregate demand, has just not caught up to it for any number of reasons. And so trying to push more credit is a real problem. And as I know that you say many times that the credit drives economic growth, but the liquidity right now is driving asset growth. And when it gets too far ahead, it does beg a lot of questions, especially when, liquidity drives credit and credit drives debt, and debt, if I can use the word leverage debt, is what's driving profits right now solely.
Yes, exactly. So I think that as a starting point for investors or anyone interested in economics or current events, the thing to understand is that this credit exploded once we removed the link between dollars and gold. Up until 1968, the Fed had to maintain at least 25% gold backing for all of the dollars that it issued. But Congress removed that requirement in 1968, and that's the thing that removed all the constraints on how much credit could be created. And so afterwards, credit absolutely exploded.
As did our current account negative balances, too, and our trade balances. It's amazing, Richard, how closely they mirror each other. Negative versus positive.
Right, that's a very interesting point, because under a gold standard or the quasi-gold standard Bretton Woods system, trade between countries had to balance. It was impossible for a large country to run a large trade deficit, because if in the past a country with a trade deficit had to pay with gold.
Precisely.
And if it had a trade deficit for very long, it would run out of gold, and therefore wouldn't be able to continue having a large trade deficit.
And you'll notice this chart I have up now, Richard, it almost shows exactly, so you say 68 when we reneged on using gold, though it was 71, August of 71, before Richard Nixon made his final decision taking us off the gold standard. But you can see that we were already in troubles then, and quickly has accelerated. And that current account has actually been Triffin's paradoxes, which has been funding the acceleration in global growth, which on the surface is very positive, but not when you've got this, as I said earlier, this overcapacity glut that somehow got to balance.
Yes, this U.S. current account deficit fueled the global economic boom. But now the U.S. current account deficit is correcting, and it's throwing off less liquidity into the global economy, creating a much more difficult global economic environment.
As a global economist, international finance, Richard, you're very attuned to this, but I really don't think that the vast majority fully appreciate the fact that for those who have a negative deficit, others can have a positive current account, which allows the world to grow. So in actual fact, the stronger the U.S. economy then gets in regards to improving its balance of trade and current accounts, is actually a draw on the world's liquidity.
Yes, that's right. And it's such an unexpected development, this shale oil revolution in the U.S. Now the U.S. is importing less oil and exporting more petroleum-related products. That's bringing down our trade deficit. So that's throwing off fewer dollars into the global economy, and it's making it more difficult for the rest of the world to grow.
Now, Macro Watch really focuses on showing what all this means, does it not?
Yes, that's right. It's very focused on my belief that today credit growth drives economic growth, and that it's liquidity that determines the direction of asset prices. And the government attempts to control both credit growth and liquidity to make sure that the economy continues to grow, or I could say to make sure the economy doesn't collapse. So MacroWatch analyzes trends in credit growth, liquidity, and government policy in order to anticipate their impact on economic growth and asset prices.
I have up your a chart on total credit and GDP growth.
Yes, this one's interesting because you can see there are two bars. The red bar shows the GDP growth, and the blue bar shows the year-on-year increase in credit growth, adjusted for inflation. And the thing to notice here is that going back to 1952, you can say almost all the way to World War II, there have only been 9 years before the crisis started when credit grew by less than 2%. And every time that happened, there was a recession. And the recession didn't end until there was another very big surge of credit expansion. So in other words, since World War II, credit growth has been driving economic growth. And when we don't have credit growth, we don't have economic growth. So this begs the question, what about the future? Are we going to have more credit growth now, or are we not? And it looks to me that we're not going to have enough credit growth to drive the economy. And for that reason, I think it's going to force the Fed to continue with quantitative easing for longer than they are currently letting on. They told us they're going to end QE by the end of this year. I don't think they will. And the reason you can see in part in this next chart, which you've just put up. This shows the year-on-year increase in credit in dollar terms. Each bar represents a quarter. So in the most recent quarter, total credit is expanding by 1.8 trillion. Now, in order for credit to grow by, remember, we need credit growth to grow by at least 2% after inflation. Well, if we assume that the inflation rate's 2%, then we need total credit to grow by 4% to get there. On a base of $58 trillion, 4% of $58 trillion is $2.3 trillion. So we need credit to grow by $2.3 trillion this year just to stay out of recession. And as you can see, the red bar there represents 2.3 trillion, and we're not there. We're below 1.9. And I don't think we're going to get to 2.3 trillion. And that's because the government's borrowing less, and the household sector, while household sector borrowing is beginning to pick up, it's not picking up enough to get us to that $2.3 trillion level that we need to stay out of recession. And so I think that means that the Fed is going to have to continue providing artificial stimulus to keep the economy out of recession. Now, yes, you can see in this table that you've just put up, these show the 5 big sectors of the U.S. economy: the government, the household sector, the corporate sector. The GSEs are Fannie Mae and Freddie Mac. And the last one, the private sector issuers of asset-backed securities. Well, I won't go into all the details of these numbers, but these are my projections for the next couple of years on how much they're going to increase their debt by. And when you add up each of these, what you see is that in 2014, we're probably going to have about $2.2 trillion worth of credit growth, and the next year, $2.3 trillion worth of credit growth. But on such a big base, that's not enough to hit the 2% recession threshold. In fact, it will be something like 1.8% credit growth after inflation this year and another 1.8% credit growth next year, both adjusted for inflation. And judging by the last 60 years, any time that credit growth has been that slow, we've been in recession. And I believe we would be in recession now if it were not for the Fed intervening over the last 5 years by creating $3 trillion of fiat money and pumping it into the financial markets, pushing up asset prices and creating an incredible wealth effect.
I know the household net worth in the U.S. is actually stunning. I mean, I don't think there's a full appreciation of just how well it's recovered, to the tune of about $21 trillion from post-crisis low.
Exactly. It's incredible. The net worth now is $77 trillion, household sector net worth. And as you said, this is 21 trillion more than it was in 2009 at the bottom of the crisis. But beyond that, it's 12% higher than it was at the pre-crisis peak in 2007. So the reason asset prices have gone up so much, of course, is because the Fed's created the money from thin air, injected it into the financial markets, buying bonds, And this has pushed up stock prices. As you know, the stock market went up 30% last year. Home prices are up 13% last year. And this has created wealth that has allowed the Americans to spend more, a wealth effect, to spend more than they would have been able to otherwise, because all the while the median income in the United States is dropping. People are earning less because globalization is resulting in the high-paying manufacturing jobs disappearing and putting extreme downward pressure on wages. So that's how the Fed's managing the economy, by creating a wealth effect through quantitative easing and through pushing up asset prices. That's going to continue.
Yeah, this keeps working as long as the liquidity keeps increasing, or at least maintaining itself. I know I was just listening to an interview you did with CNBC in India when you were in Mumbai. And I can tell you, for those, it's posted on my site for the listeners that like to listen to it, but you kind of stunned the interviewers when you suggested that quantitative easing had to continue.
Yes, right now, that is certainly not the consensus opinion.
Well, clearly, they were stunned that you would even suggest that.
Well, it's interesting to me that that is so stunning, because after all, the Fed has stopped quantitative easing twice before. And both times the stock market fell and the economy weakened and they started it up again. So what's so different this time? The same thing will happen. If they stop QE at the end of this year, as they have suggested, then stock prices are going to fall, home prices are going to fall, interest rates are going to go up, and wealth is going to contract, consumption will drop, and we'll go back into a global recession. And then they'll start QE4. But I don't even think they will stop QE3. I think they're just going to announce sometime a little later in the year that it's going to continue for longer than they originally suggested. Now, you have the taper schedule table up now. And the Fed, Ben Bernanke, held a press conference after the most recent Fed meeting on December 18th. And what he told us then is that if the economy continues to improve in line with their expectations, then they expect that they will probably reduce the amount of fiat money they create every month by $10 billion after each meeting. Well, they meet every 6 weeks, so it's easy enough to calculate how much fiat money they intend to create every month and every quarter. And that's what's shown in this taper schedule table. You can see that according to this schedule, they're going to create $205 billion in the first quarter, $145 billion in the second quarter, $85 billion in the third quarter, and only 20 in the fourth quarter. And they will end quantitative easing altogether by either November or December. So that's what they have suggested. But I don't believe that they're going to stick with the schedule, because if they do, liquidity is going to go from being excessive to being excessively tight. And when it becomes tight, then interest rates will go up, and the stock market will fall, and the property market will fall, and the U.S. will go back into recession. So having worked so hard to push the asset prices up, I don't think they're going to sit by and let them drop again. They need the stock market to keep going up, and they need the property market to go up. They just don't want them to skyrocket up and lead to a very big bubble in the next year or two. They want them to go up steadily and gradually and create just enough wealth to drive the economy, but not so much wealth that they create an unsustainable bubble that implodes in the near term and wreaks havoc again.
Richard, you have a proprietary liquidity gauge that you, part of your subscription service. I have a chart here kind of netting at some of it. Now, you have 182 slides and an hour and 40 minutes of video every quarter, kind of really getting into the detail, but just at a very high level, a sense of what how the liquidity gauge is working?
Yes, I believe, as I've said, that it's liquidity now that drives asset prices. Forget about their fundamentals. What matters is whether there's excess liquidity or inadequate liquidity. And it's relatively easy, I think, to explain this liquidity gauge, but I'm afraid we don't have enough time today to go into the details. But just let me simplify it a bit. When the Fed, as it did last year, the Fed created $1 trillion of fiat money and injected it into the financial markets. So that's an injection of liquidity. And last year, the government borrowed almost $700 billion to fund its budget deficit. So that deducted liquidity from the financial markets. But what that tells us is that the Fed created $1 trillion, the government borrowed $700 billion. So the Fed created more than enough liquidity to finance the government's entire budget deficit last year. And there was $300 billion left over in addition to the financing the budget deficit. An extra $300 billion went into other asset classes like stocks and other bonds and property. And you can see in this chart that in 2013, last year, we had the record amount of excess liquidity. And that's the reason the stock market went up 30% and why home prices went up 13%. And you can see that in earlier periods, look at the previous peaks back in the year 2000 when we had excess liquidity as measured by my liquidity gauge. What happened then? We had the NASDAQ bubble. And then in 2006 and 7, the other obvious peak. Well, of course, that was the property bubble. So it's relatively easy. It's a bit more complicated than I've made it out just now, but not too much more complicated. And the thing to notice for the next couple of years is that beginning in 2014, the liquidity is going to become very much less than it was last year. And in 2015, it's going to turn negative. Now, that suggests to me that the Fed is going to have to pump in more liquidity than it's currently suggesting that it will. Otherwise, the economy is going to go back into recession. Now, there's one other aspect of this. We're just looking at each bar here represents a year. But for investors, it's much more important to look as closely as possible. And we can produce this liquidity gauge on a quarter-by-quarter basis. And that gives us a very different story for 2014 than is suggested simply by looking at 2014 as a whole.
And I need to stress to our listeners, too, you look at this, we're talking about the Fed here in total, but you're looking at it on a global basis, consolidating what you think is going to happen with the ECB, what you think is going to happen with the People's Bank of China, et cetera.
Yes, that's right. There's one section of the last section of Macro Watch this time seems to have been very well timed. It's called The Threat of Global Deflation. And several weeks after it was published, just last week, in fact, the managing director of the IMF, Christine Lagarde, made a speech warning the world that this crisis is not over and that we're facing a very real threat of global deflation. She said she referred to the possibility of deflation as a great ogre and that the risks were increasing. So that's another reason why I believe it's unlikely the Fed can reduce quantitative easing or end quantitative easing, because if it stops printing fiat money, it's just going to result in even more downward pressure on prices, increasing the risk that we will slide into global deflation.
We're running up against our hard line here, Richard, and kind of wrapping up. I know you have some expectations here of what you think the liquidity will need to be in this year and next year in terms of additions.
Yes, I think the key is that if the liquidity really, if the Fed continues with this current liquidity schedule, then liquidity is going to start becoming very tight by the middle of this year. And in that case, interest rates would start rising and stocks would start falling and home prices would start falling. So somewhere around that point, I think the Fed is going to have to backtrack and announce that there's going to be more QE for longer. We'll see. Of course, no one has a very clear crystal ball. We can watch the incoming data and see how this plays out. But my best estimate is that we're going to see somewhere between $500 billion and $1 trillion of quantitative easing this year and also again next year, and perhaps well beyond.
Richard, great information here this morning. I thank you very much for it. For our listeners, you can sign up for Richard's services on my site. For those who are macro analytic listeners or subscribers on my site or trial subscribers, we have a special coupon discount for Richard's services when you can get the coupon code on my site. Richard, is there any final comments you'd like to make before we break?
I think we're living in a very, very interesting time. As you mentioned, I was in Mumbai last week, and the people there are very concerned about what the Fed is going to do next and how that's going to affect the global liquidity flows that they must rely on in India to fund their current account deficit. So everyone is watching the Fed, and that's what I'm going to be doing, watching the Fed very carefully. It's going to be fascinating to see what they do next.
Richard, looking forward to having you back in the future, because there's so many things to talk about, and I apologize, we just barely touched the surface of your product here this morning, but hopefully we've given our listeners a sense of what's important, and that today you need new tools and new perspectives to look at your investments, because it's being driven differently. And as Richard said, liquidity is driving asset prices, but credit is what's driving the economic activity. Unless you can really measure it and you can kind of get an assessment of where things are shifting, because it's not in the press, it's going to be a volatile time for you. Richard, thanks again. I'm looking forward to having you back. All the best.
Thanks, Gord. Great talking with you.
Talk to you. Bye.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.